Thank you for standing by, and welcome to the Limeade Q2 2021 Investor Conference Call. All participants are in a listen-only mode. There will be a presentation followed by a question-and-answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Henry Albrecht, CEO. Please go ahead.
Thank you, operator. Limeade CEO Henry Albrecht here, presenting our cash flow results for the second quarter ended 30 June 2021. Joining me today is Todd Sparks, Chief Financial Officer of Limeade, who was appointed in May 2021, just this year. Welcome, Todd. There are 3 main takeaways for the quarter. First, we're seeing new contract momentum as we get later into the year, and we're planning to build on that momentum through our partnership with Microsoft Viva and core product enhancements to bolster our well-being business. We remain focused on top-line growth. Second, we're keeping costs under control on our path to profitability, investing where we need to for the future. And third, our cash position is strong, even after the exciting TinyPulse acquisition announced 2 days ago. During Q2 2021, Limeade signed 3 new enterprise contracts. In Q2 of 2020, the number was 2, including 2 US-based companies and 1 European company. In the prior corresponding period, the company signed 2 contracts. I'll remind investors that our contracting cycle is heavily weighted to the second half of the year, with sales often leading to launches in the first half of the following year. Accordingly, contract signing is starting to pick up. It is still not returned to pre-pandemic levels, but we are optimistic based on what our teams are experiencing in the field, combined with reports from third-party analysts about increasing demand. Turning now to pipeline. The company's total sales and marketing pipeline at Q2 2021 declined 14% versus Q1 2021 to $156 million, driven predominantly by a decline in the early stage qualifying or marketing pipeline. The company's finalist and verbal pipeline was $9.4 million as at 30 June 2021, down 19% versus Q1 2021. Limeade continues to pursue its return to growth in the COVID era as HR and more specifically benefits budgets show signs of returning in our core North American well-being market. We look forward to a strong second half. Our overall year-to-date net revenue retention was 93% as at 30 June 2021. Limeade's direct customer NRR, 94%, a decline of 4% versus the PCP, while indirect partner NRR was 82%. The indirect channel, which tends to focus on mid-market and small to medium enterprises, continues to experience persistent customer churn. I will now provide a brief summary of our quarter cash flow information as released to the ASX this morning. I'm pleased to report that the company remains in a solid financial position with our cash position of $28.7 million as at 30 June 2021. On Tuesday, Australian time, Limeade announced the acquisition of TinyPulse, a Seattle and Saigon, Vietnam-based leader in employee listening software, for $8.8 million in cash, funded from existing cash reserves. The transaction is expected to close in July 2021. Our net cash position after the acquisition still provides us with the flexibility to explore other acquisition opportunities, and we hold a $15 million undrawn credit facility. That said, we plan to focus on high-quality execution in the core Limeade and TinyPulse businesses in the short term. In Q2 2021, the company recorded operating cash outflows of $2.0 million, down 18% versus the PCP, reflecting the lower overall level of enterprise contracts signed in FY20 due to COVID-19 and the effects on cash collections. During the quarter, the company recorded cash receipts from customers of $13.7 million, down 21% versus the PCP, reflecting lower sales of third-party products and services and the lower overall level of enterprise contracts signed in FY20 due to COVID-19. Net cash receipts from customers after adjusting for payments made in relation to the sale of third-party products and services was 10.4 million, down just 1% versus the PCP. Cash payments during the quarter were primarily directed toward the following costs: staff, 8.7 million, administrative and corporate, 1.7 million, operating, 0.8 million, marketing, 0.6 million, and research and development, 0.5 million. As a reminder, all dollars are USD. Staff costs increased 2% versus the PCP and were down 18% versus Q1 2021. In addition to Todd Sparts as CFO, Limeade also appointed Ms. Elizabeth Liz Carver as Chief People Officer, or CPO. Both Todd and Liz are accomplished, high-caliber individuals with strong public company experience driving organizational performance and improvement. I could not be more pleased with their contributions to the company since joining. Investing cash flows of 0.8 million were up 4% from the first quarter, primarily due to investments in software development. Turning now to our expectations for the full year FY21. We reaffirm guidance for the core Limeade business with forecast revenue of 50 to 53 million and an EBITDA loss of 5 to 8 million. After we close and spend approximately 30 days reviewing 2021 performance of our proposed acquisition, TinyPulse, we expect to provide updated guidance to the market. With the recent Microsoft Viva Connections partnership and TinyPulse acquisition, we've proven our commitment to innovation and a return to growth. As mentioned by Microsoft CEO Satya Nadella at the 2021 Microsoft Inspire conference held last week, companies need to foster social capital, knowledge capital, and human capital, all while emphasizing employee well-being. As a leader in employee well-being, Limeade remains at the forefront of this important development in the future of work. I would now like to hand over to the operator for the question and answer session.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Seth Hoskin of Canaccord Genuity. Please go ahead.
Thanks, operator. Morning, Henry. Morning, Todd. Or afternoon to you guys. Just firstly, on the 3 enterprise deals you signed, are you able to comment on whether they were well-being deals or any multi-solution deals within them? Just trying to get a bit of a feel for the size of those deals.
We'll share more updates at the August update in a month when we share our full half returns. Right now, these are enterprise contracts in both Europe, where we tend to sign more what I would call kind of broader footprint deals, and in North America, where we tend to sign more well-being deals.
Cool. No, that's really helpful. And then just on the direct NRR, is it a fair assumption to think that this is largely still sort of upsell rather than churn moving directionally, or has there been any notable churn events through the period?
It's a little bit of both, candidly, Seth. I would say the COVID-19 pandemic continues to, or at least in the first half of the year, continued to dampen enterprise spending on health and benefits, which is our primary budget in North America, where the bulk of our business is. We're excited to see the lifting of some of those constraints that we believe are not just Limeade specific, but industry-wide. And we're seeing some real green shoots of return to demand in the market. And that demand affects both upsell and new contract signings. But I think the upsell is probably not going to be what we've seen in the past. And one thing I think is an interesting thing to note is if you probably heard that there was only a 1% change in the net cash receipts from our software business, but there was a relatively significant decrease in the sale of third-party services. And we attribute that, A, to strong demand for Limeade and satisfaction with the Limeade technology, but companies who are actively looking for ways to eliminate additional expenses through the COVID kind of cost containment era. And so we believe that demand actually impacts not just biometric screenings and incentive fulfillment and other services that were cut, but potentially also puts on hold some of the larger expansion and upsell opportunities for Limeade. That said, we also believe that it signals a strength in the core relationships we have with our direct enterprise customers.
Cool. That's really helpful. Thanks, Henry. And you touched on it briefly in terms of, contract signings picking up, momentum seems to be coming back, but not at that pre-COVID level. Are you able to kind of, I suppose, add any further color in terms of what you're seeing in terms of the willingness of your HR buyer benefits, or just like commentary or thoughts and what sales feedback is versus 12 months ago? And then if we look at kind of your sales pipeline, are you able to comment on, as we move into the third and fourth quarter, how the bottom of that funnel picks up going into those quarters? Obviously, we just get a quarterly or half-yearly update on what that looks like.
Yeah, I think because we do sign contracts as opposed to just having them in the kind of later stages and verbal award and finalist stages, we will sign contracts. We will have contract signings to announce. It's highly likely we will have more contract signings to announce in Q3 than in Q2, which is the typical historical pattern of our business. The first part of your question, I'll try to address, and then maybe call on Todd if he has any additional color. So yes, we see that there is an acceleration in the later stages and demands for the business. I would say, how does this compare to 12 months ago? I don't think it could be any more different. It's hard to even remember back 12 months ago when the U.S. economy was shut down. I think that people were frozen in ways that they're not now. Business is largely, I wouldn't say return to normal, but people are going through normal budgeting cycles for their 2022 year. And I believe that, they're building in more thinking about employee well-being and employee listening, and how do we keep a pulse of this remote distributed workforce in ways that we haven't before. And so I think it's a very different time. But the churn and the business slowdown that has happened, let's say, since COVID started in the prior 16, 18 months, we believe is largely in the rearview mirror in the States. We know that in Australia, in Asia, and other places, it's actually probably going the other direction right now, from what I understand.
That's really helpful. And just one final comment. You obviously announced the partnership with Viva, and I'm sure that's a key part of the product roadmap. But is there any other kind of product initiatives or launches that we can sort of expect in the second half of the year?
Well, first of all, we're super excited about the TinyPulse acquisition. So I think you'll see us continue to invest in our core Limeade Wellbeing experience, and we will have product updates to announce related to just our core business. We're excited about the innovations happening at great speed in the TinyPulse business. But I think maybe one thing to take away is what we've announced with Viva is very much the tip of the iceberg. We think there's a huge opportunity to embed well-being experiences and listening experiences in the flow of work. We believe that listening to employees is at the heart of well-being in many ways, and well-being is at the heart of the employee experience. And if you can infuse care about people and their emotional well-being and burnout and social isolation and make connections with people using platforms like Microsoft Viva, where hundreds of millions of people live every day, it's worth maybe doubling down on and not chasing too many other leads around. So we're committed to that further innovation in that direction.
Thanks, Henry. Thanks, Todd. Thanks for taking questions.
Thank you, Seth. Appreciate the questions.
Thank you. Once again, if you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. Your next question comes from Tim Lawson of Macquarie. Please go ahead.
Hi, Henry. Just a few points, maybe of clarification more than anything from me. Just in terms of the revenue mix of direct and indirect, can you remind us where that sort of sits now with that churn that continues to go on, and how much direct is versus indirect in the revenue?
Todd, do you want to take that one? Have you muted yourself, Todd?
Apologies. Yes. The indirect business, we are experiencing continued slowness. I think COVID has caused the indirect customers, which are typically, as Henry alluded to, more mid-market and smaller, to be a little more cautious about spending. And so, it's really a situation of the customers and the deals in the direct business are healthy, and the indirect less so.
And in terms of percentages, we would expect, I think the last time we spoke, Tim, we said, roughly 10% of the business was indirect and 90% direct. I think in general, we expect that to stay roughly the same, but it might not be the exact same mix. As we think about indirect partners, we'll be looking for strong, very purpose-aligned partners. So I would expect that to be a little bit more of a volatile part of the business than the direct business, frankly. The good news is it's a smaller part of the business than the direct business.
Yeah, okay. And you've called out, you mentioned earlier in the call how you can't really compare to last year, and you've given us the pipeline sequentially. But just trying to understand, is it normal to see the pipeline decline from first quarter to second quarter, and what's the context of those percentages you've given us when it's given in a sequential way?
Yes, you can think of it as normal. We also may share more in August just about year-over-year changes, but yeah, it's been a strange couple of years for pipeline, but it's normal to see the decline because of the seasonality of our business. Budget is created and budgets go away. If the budgets aren't being created as much right now at this time of year as they might be, in the fall and winter going into the next buying cycle. So there's some normalcy to it, but it's hard to call anything normal in the COVID era. But yeah, that's a fair observation.
Yeah, okay. And then just with the new customers, when do they actually start to contribute revenue? Are they paying customers now, or do they sign on and then become active at some point during the second half?
Yeah, I don't actually have the launch date estimates for those customers at my fingertips right now, Tim, but that's something that we would be happy to provide more detail on in the future.
Yeah, but they're not launched now, and so therefore they're not in.
Typically, it depends. I believe that, typically post-contract signing, we would see a 3 to 4 month delay typically before launching. Sometimes, however, we do sign deals as early as April or May or June of a year, and they really don't want to launch to their employee base until the first quarter, sometimes even the second quarter of the following year. So it's really at the discretion of our enterprise customers. The only thing I'll say on revenue guidance, because I think that is probably the most relevant aspect, is, we're reaffirming our guidance for the year.
Yeah, okay. And just on that, the third-party revenue, I mean, to a degree, it's a pass-through for you that does, as you sort of indicate, how much companies are active with their employees and obviously still supporting Limeade. But you're trying to think about, has the mix impacts had any sort of consequence for third-party revenue, and what are the trends that you can see within the quarter? So are you seeing the level of activity on third-party revenue improving throughout the quarter?
Well, I'll take the first crack at that, Todd, and feel free to add. I think when you think about third-party services, some of the non-recurring services, some of them are things like employee incentives or gift cards or things paid to people to do specific well-being activities, or do preventive care, see their physicians or things like that. And so there's some decline in that I believe is largely macroeconomically driven. The second part of it is that some of it is things like biometric screening services where people come in and their blood is drawn and they're given indication whether they may be at risk for diabetes or heart disease and that kind of thing. And a lot of those have been put on hold specifically due to COVID, due to prioritizing other vaccination events, due to offices being closed, et cetera. So there's really a couple different causes of those reductions in one-time revenue, in addition to just kind of macroeconomical conservatism on the behalf of the enterprise customers we serve.
Yeah, okay, that's clear. Thank you.
Thank you. Once again, if you wish to ask a question, please press star one on your telephone and wait for your name to be announced. Your next question comes from Sean Kumar of Shamirs Global. Please go ahead.
Hi, Henry. Hi, Todd. Thanks for your time. Thanks for taking my questions. I have two, if I may.
Sure.
Okay, great. So first question is, I noticed the incentive stock options that were issued to Henry last month have a vesting hurdle based on the company growing CAR annually for the next 3 years at around 15%. So I guess my question with that is, should we think about that level of growth as something that's possible under the company's current structure, as end markets normalize and some of those headwinds fade? Or would this be more of, an aspirational level of growth that would, require a larger step function increase in investment in headcount or sales resources or something like that?
Oh, that's a good question, Sean. I'll take the first crack, and Todd can augment anything I say. I would say, first of all, compensation is not a Henry or Todd decision. That's a decision made by the Remuneration and Nomination Committee of our board, and I serve at their discretion. So I know that they would set targets, as is the right governance thing to do, that they believe are achievable. And so that the first point of answer is, other than the COVID-related headwinds, I believe that the board sets, I hope a little bit stretched, but certainly achievable goals. To the first part of your question, Todd, do you want to add anything, or maybe take on the second part of that?
I would just add that, the company is certainly taking a very careful look at its long-range plans. So we're actively pursuing, what will we achieve in 21, 22, and 23. And, it's a little early for us to kind of communicate that. As we indicated, we're really taking a very hard look at Tiny Pulse. We're continuing to do due diligence. We've already done extensive amounts, but we continue to kind of dive deeply into their revenue and assuming what their retention will be and what their growth opportunities are and what kind of opportunities there will present itself when we're combining a well-being and listening product together down the road when those products are integrated. So, given that this is long-range compensation, you're really asking for a long-range plan around bookings growth. And we're looking at that very carefully, but I don't think we're at a point today where we can kind of give you guidance as to whether or not that's an aspirational goal or something more achievable.
The only thing I would add to what Todd said on that front is we have terrific growth opportunities ahead of us, both in just the core organic running the business element and perhaps some more disruptive and expansive things to do, whether those be organic growth or inorganic growth. If we see opportunities to accelerate growth, we're happy to invest in those growth vectors. And I think that we have a board that's supportive not just of achieving and reaffirming our guidance quarter to quarter and year to year, but pursuing this massive opportunity in front of us in infusing well-being into the flow of work. So, we can manage the business and our costs, as we showed last year, showing positive EBITDA in an extremely challenging year. We have a strong recurring revenue base to the business. and long-term contracts with marquee enterprise-level customers. So we feel a great deal of control over, how we manage the balance sheet and our cash in that regard. And I think, we've shown that by having, $28.7 million at bank, at the end of the quarter, as of June 30th. So thanks for the question. If there's extensions to it, happy to answer them as well.
Sure. That was great on the first question. My second question is, completely unrelated. My second question on the Microsoft partnership, on the Veeva partnership. So first off, congrats. That's a huge win for the company, I'm sure. And I appreciate you probably can't share any figures at this point on that partnership, but just curious if there's anything on the structure that you might be able to share with us. So, perhaps for example, does Limeade receive a fee based on usage within the across the platform? Based on kind of user metrics, or just broadly speaking, how should we think about the way that Limeade is remunerated in that partnership?
The only things I would say is, first of all, it's a brand new thing. I mean, Veeva was just announced in the last couple of months. I think it's new to them as well in terms of what's new to the market. So we just know that we're committed to, as a Microsoft-oriented company in general, being here in Bellevue, Washington, in the shadow of Microsoft. We've always found it important to use great Microsoft technologies and stay close to the biggest, best enterprise software company in the world. The second thing is, the good news for our investor community is the ASX will require us to report anything that has to do with, kind of material revenue impacts related to this. So as of now, since we haven't reported those, that's probably a good indication that this is, early days in the world of Microsoft Veeva, and nothing to report there.
Okay, but and again, not on figures, but just directionally, should we think about it as you are integrated into Veeva, and then there'll be some KPI that's tracked on usage, and some metric will be calculated based on that?
I think I would think about it, well, I suppose you could think about it how you like. We view it actually from a very user and customer-centric lens. The user-centric lens is, if you're living and breathing in Microsoft Teams or SharePoint or some of the other surfaces that you do your day-to-day work in and you're collaborating and innovating on, but perhaps you need a nudge to get up from your desk and stretch and take a breather and maybe want to connect with some of your benefits that you're unaware of, or some unknown resources to enhance your well-being. We want to make sure we're putting that at your fingertips right into the flow of work. And from a customer point of view, we have many large enterprise customers who are extremely happy Microsoft Teams and Veeva customers, and they're coming to us with demand, saying one of the ways that we can solidify our relationship with Limeade and perhaps expand it over time is to make sure that you're a good partner into this ecosystem as well. So that's really our lens, is how do we get more customers and serve our customers and their users or employees better through a very tight integration, and putting all of the capabilities of Limeade into the flow of work through this Microsoft Veeva. So that's just the lens we take through it. Obviously, if we have anything material from any sort of upside perspective with any partner or customer, we will report those to the ASX according to their guidelines.
Great. Thank you.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Marco Correa of Perennial. Please go ahead.
Hi guys, how you doing? Just one from me. The third-party cash flows obviously reduced in the quarter, which may be an indication of a use case of Limeade's product reducing. Does this, I guess if I'm looking at like your churn, does it negatively impact your churn? Is there a link of lower third-party usage on the platform and possibly a reduction of the use case, and then therefore leading to some churn at all?
I wouldn't
I think
make that connection.
Yeah.
Personally,
Okay.
because our platform usage and the usage of, let's say, a biometric screening are not really viewed the same way by our customers. They would view one as a biometric screening event, and the use of our software is a different thing. So my short answer would be no. Todd, anything to add?
Yeah, I would just add that, yeah, you can see that the cash flows, that the customer receipts were almost identically offset by the payments reductions to the third-party providers. And so that's telling me that customers are valuing the platform, and where necessary, if any cuts are taking place, they're taking place in those third-party pieces of content.
Yeah.
So, I would look at it not impacting churn. It's impacting content third-party solutions that are added to the platform.
Yeah, okay. So it's added a degree of comfort for you guys that there's value to some of the end consumers that have been using third parties that have stopped using it as much, but still continue to use the platform.
Yes, and I think that it's likely that many of those services will return over time.
Yeah, okay. Yeah, that's all for me. Thanks.
Thanks, Marco.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Albrecht for closing remarks.
Thank you, operator, and thank you all for joining the call today and for your great questions. We look forward to catching up with you all once more for our half-year results in late August. If not sooner, onward.
That does conclude our conference for today. Thank you for participating. You may now disconnect.